presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for May the 5th, 2025. I'm Mo Ansari, and thank you for joining me today. First of all, remind all of you, click on the subscribe channel so whenever I post an update, you'll be notified and you can watch it whenever it's convenient for you. So subscribe, click on the subscribe button, or just go to compact.com/YouTube if you want to watch some of the older episodes there. Looking at the markets, wonderful week. We've gained nearly all the stuff, all the decline that we had seen since Liberation Day, as it was called. We were up 2.94%, biggest run in the market 9 days in a row. Today it came to an end, but we had some good run up in the market, and we're about 5,700 plus or minus. Dow Jones gained 3% last week, NASDAQ up 3.43%, even the Russell was up 3.24%. So wonderful. Now year to date, the S&P is down 2.91%. So if you have a balanced portfolio, you're down 1 or 2% in your portfolio from where you started the year, you're okay. But if you had the urge to push the eject button in April when the markets were at their lows and you were panicking, then now is the time. That wasn't the time. Now is the time to rebalance and fix your portfolio. Need help? Call us at 800-388-9700, 1-800-388-9700, or just send me an email at invest@compact.com. We'll sit down with you. We'll develop a plan for you. All of it is free. Looking at the industrials today, look at the best. They were the best last week, up 4.3%. Energy was the worst, down 0.6%. S&P, as I mentioned, year to date is down 2.9%. So we've gone back and forth, and now we've come back up. I think we need some backing and filling here. Or we could go just break out to the upside. We are at resistance levels now, and I'll show you when we take a look at the charts a little bit later on. Oil down quite a bit, and it hit a new low today for the year at nearly $55 a barrel. Saudi Arabia is increasing production, which is bringing more oil to the market. And if we do get a slowdown in the global economy, demand for oil also goes down. Interest rates just about stable. Not much of a change in interest rates, 4.29 the week before, 4.33 last Friday. Today we're 4.34. So not a lot. Interest rates are waiting and watching. We have a Fed meeting this week. No change expected from the Fed. I think everybody is in a wait and see. How do we resolve the trade? And I think everybody's backing off from the dramatic announcement we were seeing in trade. Most countries are going to come up and make some deals, which is going to be good overall. More rebalancing of trade. China is the outlier. How do we resolve with China? Those are going to take longer, those talks. We're going to go back and forth. We could see some tariffs. We could see some more pressure in China. We could see some more pressure on the U.S. with empty shelves and prices going up for certain things, and people complain. That might put some more pressure on the administration. So it'll take, I believe, a little bit longer. But the big question, as I've said, is the budget talks. How do they come out? What happens with the tax decreases? How much do we cut taxes? How much do we cut spending in the federal government? Where those spending cuts are going to be? That, I think, is going to be the next big driver of the markets, of interest rates and the markets. And that's going to take, I think, July 4th is the target date that the administration is setting to bring the bill to the House floor and the Senate floor. So we'll see what that. This is an interesting hard data. When it is up here, usually unemployment is down here. But the expectation, unemployment usually when here, we are about here right now. It's just so different what the expectations are, what reality is in the data, and what people are expecting. They're expecting a crash. They're expecting, because of the volatility in the market, has created a lot of anxiety with consumers. That is what we're seeing. But in reality, if you look at earnings, you look at forward guidance, it's not that bad. You look at unemployment numbers, they come out last Friday, 177,000 jobs created. Expectation was about 130,000. Economy is doing okay. It's not gone off the cliff yet, because all the stuff as far as trade, it takes a long time. Figuring out a trade deal takes 18 months. To implement a trade deal takes 4 years. So expect a trade deal to be done in a week or two. It's not going to happen. It's going to take long, hard negotiations. I think with China. With other countries, I think it could be much faster, which is going to be positive for the market. GDP, as I said, fell 0.3% last quarter, but that was because we imported a lot more stuff. And the import number of 1.8% deduction from the GDP. And if you put that, and that is because everybody imported a lot more stuff to try and get ahead of the tariffs. That's what we saw. Non-farm payroll, as I mentioned, up 177,000. ISM number came out at 51.6. That's showing non-manufacturing is doing okay. We'll wait and see how the rest of the data comes out. Technically, here's the 200-day moving average right here, 57.46. This magenta line right here. Market is right here at 56.70. So we're stuck. The 50-day moving average is 55.75. So I think we're in this range, going back and forth between 57.50 and 56.75. Back and forth, back and forth. We could see some more decline down here, down to this level at 5,500. But that's, I think, what we're going to see. If this is wave 1, wave 2, wave 3, and wave 4, we come down in wave 4. But wave 4s, I think, are choppy. On the weekly charts, we already have completed wave 4. Looks like we're headed up. 57.06 is the number. We came and kissed it. That's the 50-week moving average. Last week, today we're below it. We're at 56.70, 56.50, right around there. We need to get above here. And if we get above 57.06, 5,700, and then above the 200-day moving average, which is around 57.5, then I think we are headed higher. But in the short term, I think we need some backing and filling. That's what we expect to see from the charts. Same picture, 200-day moving average, 18.3. We're at 17.9. Going back and forth, I think we get some more backing and filling here. Same thing, fourth wave came down all the way down here. Fifth wave should take us to new highs. But fourth waves, we're right at the 20-week moving average. We get a break above it, then 18.3 or 18.2 is the number. We're at 17.9. So if you can get above the 50-week moving average, that would be good. The dot plot, as I always look at it, market is below that. And the dot plot has come down to 18.6 and is coming down further. Market, so we're getting closer to the dot plot turning positive like it did here. When the dot plot is positive, market is headed up. Dot plot negative, market is headed down. These are the dots. As long as they're above the market, it's a negative situation. As long as it's above the market, it's positive. That's the way I'm looking at it right now. Interest rates stuck in a range, really 4.5 to 3.8 in this range. Just back and forth, back and forth, back and forth. I don't expect any change in interest rates. As long as we stay below 4.8 and above 3.8, we're okay. Gold, big update today. Came and tested the 20-day moving average right here. Today we became up $90 or so in gold. I think we're going to bounce around here for a while in gold. Oil was the big news today, down big. I think we're getting closer to a bottom in the oil market. But we could see we're down to $55 a barrel today, closing at 57. So 55 is the low for the year in oil. And that could bring inflation numbers down. That is good for the consumer. If they go to the pump and they don't have to pay as much, that would be a very positive for the consumer. Those are my thoughts. Those are my observations. Again, don't forget to subscribe to this channel. Click on that subscribe button, and whenever I post an update, you will be notified. If you need help with your portfolio, send us an email at invest@compact.com or just call me at 800-388-9700. Have a wonderful week. I will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.